The 15-minute time frame, what you're doing is you're looking at time first. And let me first cancel out the confusion I probably caused some of you. So here's 7 o'clock in the morning today. The things I mentioned yesterday where I said you want to start at 7 o'clock in the morning, that's true. You don't want to look at anything prior to 7 o'clock. That's the earliest you can refer to in price. At 7 o'clock in the morning, that begins your hunt for relative equal highs or relative equal lows. What I meant to say, but I wasn't very successful or articulate in the way I said it, is when I was referring to the London session, you do not, this is the part where I said this is really important, this is key takeaway information, do not look for your relative equal highs or lows prior to 7 o'clock. That does not mean students that have learned models from me in private mentorship that they shouldn't be doing an observation on these relative equal highs. Because if you're looking at prior to anything at 7 o'clock in the morning, what you're really doing is you're referring to London sessions price data and its profile. You can look for setups prior to 7 o'clock in the morning, but if you're brand new, don't even worry about that right now. Trust me, you don't need anything else prior to 7 o'clock in the morning at all. At 7 o'clock in the morning, what you're doing is that's your beginning of the day. You're now starting to look for relative equal highs and lows. And you start on what time frame first? The 15-minute time frame. Okay. So this starts the hunt for at 7 o'clock. Did we create a relative equal high yet? No, we just have one singular high. Do we have relative equal lows? Don't look at this because it's before 7 o'clock in the morning. Don't do that. Don't even refer to it. The rules are very simple. You're waiting to see relative equal highs and relative equal lows form after, post 7 a.m. New York local time. Now, these two lows may be a factor for the 5-minute chart. All right, so now we do potentially have, if this starts to rally, we don't have it yet, this could potentially become relative equal lows. Now, with that, all you're doing is you're making a mental note of it. You're not annotating your chart because it's not there. So post 7 o'clock, you're scanning through, looking for relative equal highs and relative equal lows. We can't refer to that low because it's before 7 o'clock in the morning. So we go down to a 1-minute chart. And here is the 7 o'clock delineation, and you're looking for relative equal highs. Now, these have already happened, okay? So that's something that you could have observed at the time at 7 o'clock in the morning. We weren't here, obviously, at 7 o'clock, but it ran through there. So what did this do? There's two different characteristics in price delivery that is a very, very simple perception of what price has done. It took an area that's smooth and made it jagged. So what happened here? This was an engagement for liquidity. So what did it do? It took buy side. After it took that buy side, where did it go directionally? Lower. So if it's done this type of work, then you have to go back through this price leg from here down to there. See that? So what you're going to wait for is something after 7 o'clock in the morning to create relative equal lows. It could rally up, and then these relative equal lows could be the setup for a run lower. So if these become relative equal lows and it rallies higher than this high here, if it wants to go below that, how far can it go? Refer over there. That's not the same thing as looking at relative equal lows before 7 o'clock. You're just looking for liquidity for the sake of just simple liquidity. And you're referring to how far can it go beyond relative equal highs or relative equal lows. You got to look at market structure outside this parameter. We already see that they've done some work up here. There was a shark frenzy, okay? We don't want to trade up into that. We don't want to trade into this because they've already done a lot of things in here. So what we're doing is we want to see it try to make an attempt to run out some kind of a relative equal low. All you're trying to do is learn how to encapsulate price action. If this price, say all this price action here was over the course of, I don't know, 15-minute time frames or 30-minute time frames, and this was the close at 4 o'clock in the afternoon New York time. What that would indicate is that this was the daily range. It created the Judas swing here, it dropped down, and it came off the low to close near the low of the day. That's power 3. You're going to discover that every single time you sit down and you look at the AM session, you're essentially looking for that to form. You're looking for some fake manipulation that creates all of this animation, and it does the harmful work of hurting people and putting them out of a trade that would have been profitable or putting them in a direction that's not right. And now they're trapped long in this case, and then they rake them across the coals and drop it lower. And since we have done this work up here, where we had relative equal highs here and here, how do you know it's a high probability relative equal high when the right side that is identified as a potential turning point for a quote unquote potential relative equal high, the right one is going to be slightly lower then the one on the left. We have that here. We don't even need to see this ahead of time. We just need to see, okay, it ran that, and you might identify it after it does that run there, and then you start seeing it break down. See that? At the turning points or potential turning points like this, okay, this is where, and I'm going to refer to this in my book with this lecture here. All of my PD arrays have an inversion aspect to them. Every single one of them. Every single one of them can reverse their role. This is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on your understanding of what I taught you yesterday and what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? The idea of waiting for a stop run and then wait for the market to come back down into the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a SIBI. A up close candle right here, this is the opposite, which is a BISI. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs, it rallies. This buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal. That is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price, because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this, but my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there. That right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. And then this becomes a selling point. And then what do you have at this point? You have this low and this low. And what time of the day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias, because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So all you're doing is you're looking for areas where they can stop people out and go the other direction. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And notice that this is the only buy side imbalance, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs, until the narrative is likely to change bullish, your focus goes to only looking for sell side imbalances. The very first fair value gap prior to a stop run, always have that one noted, because this is a change in a direction. And what this is doing is acting just like an order block. It's just change in the state of delivery. So I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt, okay? This fair value gap, if it's not there, then you use the breaker. It's very simple. It's the last down close candle, okay? But your stop needs to be above the highest high of the consecutive down close candles, because this is all the bearish breaker, both of these candles here. So your stop has to be above that. How much? Two ticks, maybe 1 tick. Many times I've used the high, because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has the stop on. Because if you have that, then you could potentially see a whole return back up into this, and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I tossed that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then this is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. Every single SIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one, because there's stops above that. Okay, we already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here. It traded down through that. And then we had all this business in here. We swept below that here. Every sell side imbalance, every sell side imbalance. Notice how this one here, I'm not looking at that one. I won't highlight that one. I won't extend it forward, because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Then I would draw my attention to this one, because then I could act on that as an inversion fair value gap. Now, if you recall, I mentioned yesterday that 8 o'clock is the same thing. There's another point of confusion I want to clarify. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range. It is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low, or a price run lower. Well, what is that by definition? Opposing directional run that's against where you think it's directionally going to go. That's a Judas swing. That's manipulation, okay? Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning, if this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it, and then resisting and going lower. as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your 3 windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these 2 right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level, but now you do. You have a stop hunt. The market broke down. So this is a shift in market structure, okay? And this is a optimal trade entry. Each hour at 7 o'clock, in this case 8 o'clock, at 9 o'clock, what you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows because you're trying to work inside the range of the morning session. Okay, the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. I like to be done by then. Frankly, I like to be done by 10:15, 10:30. You know, if I can get something on and be paid out, I'm done. But once you have a turn in the direction like this, and the market's likely to draw lower, you'll see that by focusing on only one side of the marketplace with the inefficiencies, as we have here, it's moving lower. So every SIBI is extended to the right. And the first 30 minutes after 7 o'clock, after 8 o'clock, and after 9 o'clock, if there is relative equal highs or relative equal lows, you want to see a measure of manipulation. It doesn't have to only be in that first 30 minutes. But in my mind, I'm thinking, I want to see that. And if I got that, and it was given to me in delivery price, then my interest in this move is even more peaked. I'm really interested in it. If it doesn't do it, I'll wait for more information because it might have a deeper retracement than I would have expected initially. And then I'll wait for a breakdown. And in having all of these inefficiencies extended over, the market will refer back to them. And then all I have to do is wait for a bust to get there and then ride that thing down to Southern Town.